Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week at Everything You Need to Know in 90 seconds at 9 o'clock, with news that may be dawning on some US policymakers that China may come out on top in the trade war, and they've chosen the wrong strategy to address the imbalances. But first, the New York Fed's survey of factory business conditions, a key one amongst regional Fed surveys, has come in surprisingly flat. Analysts were expecting a minor indication of softness, but have been delivered something more concerning. It is true that the overall levels are still relatively high, but most of their key sub-indicators fell, and some quite sharply. And some of the rises, like for inventories and input prices, aren't positive either. The only positive bit is that the employment indicators held steady, neither rising nor falling. EU inflation dipped in July, slipping 0.1% to 2.1%. For the euro area, it was down to 2%. In Canada, their existing house sales fell 3.8% in volume in August compared with the same month in 2017. There are two important reasons. Major volume drops in British Columbia housing and stricter national mortgage regulations are starting to bite. The data from Vancouver is eye-catching, down 37% year-on-year in volume terms. Nationally, the average price was up 1% to $475,000, and in Vancouver, the average price was up 4.1%. Meanwhile, the OECD updated its June quarter G20 growth stats, showing this key group grew at 3.9%. That is unchanged from the first quarter of 2018 and is bolstered by improvements from India, China and Indonesia and a small set of others. And it's restrained by the US, the EU, Japan and Australia, among many others. India's 8% was the highest growth rate, South Africa's 0.5% was the lowest. On the trade war front, the Chinese don't seem eager to engage. The US is almost pleading for new talks, but China is looking away. In fact, there are reports that China might cut key exports to the US. That'd be a whole new front in the battle. Certainly it is driving China to insulate itself from US tariff pressure. The overall cost to China, perhaps as many as 700,000 jobs. But that represents less than 0.1% of their employed workforce and may not even be noticed in their labour market statistics. The net result is that China may become more competitive, not less, through all of this. Our markets are getting increasingly skittish over this chest beating. Today, Wall Street is down 0.7%, and yesterday Shanghai was down 1.1% and Hong Kong even more. But how much of that relates to recent storm damage consequences is a bit up in the air at present, although probably not much. US Treasury 10-year yield is unchanged today at 3%. Their 2-10 curve is still at 21 basis points. The Aussie government 10-year is at 2.63%, that's up 3 basis points. The Chinese government 10-year is at 3.66%, that's down 2 basis points, while the New Zealand government 10-year is at 2.61%, also up 3 basis points. And gold is up $8 today at $1,201 an ounce in New York. US oil prices are lower today at under $69 a barrel, and the Brent benchmark is now under $78 a barrel. And the Kiwi dollar is starting today firmer at 65.8 US cents. On the cross rates, we're marginally firmer too at 91.6 Aussie cents, but unchanged at 56.3 euro cents. That puts the TWI at 69.5. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.